Yeah, it's been a lot to write about. It's funny because, like I said before, I'm working on the book, and I prefer actually markets to be chill for a couple months, so I don't have to spend as much time in them, and they keep pulling me back in. It's certainly been a pretty wild, like 3 weeks here. So a couple different ways of looking at it. One is if you go back to the prior discussion we had around the Fed going broke, essentially a similar thing happened to a lot of these banks. So to quickly recap that discussion, Fed liabilities, their interest rates increased very sharply, while their asset side didn't. And so the Fed's now operating at a loss. They have a financial loss ongoing, and they have about $1 trillion in unrealized losses in their treasuries and their mortgage-backed securities. Of course, the difference is that nobody can do a run on the Federal Reserve. But if an individual bank has that situation, they can get a run. And it's funny, most banks are not as in bad shape, relatively speaking, as the Federal Reserve because their liability interest rates go up more slowly than the Federal Reserve's, and their assets are a bigger mix of types of things, and they have more capital relative to assets than the Federal Reserve. But of course, what differentiates them is that they're vulnerable to a bank run. And so what we've seen is that, if you go back to the 2008 crisis, that was because a lot of banks made bad loans. They made like subprime mortgage loans to people that, can't really afford the house that they're signing up for. And so a lot of them, defaulted. In this environment, it's the opposite. You're not seeing defaults, at least not yet. There's certain troublesome pockets on the horizon, but it's not really that type of credit event. Instead, they ironically bought super safe assets that either have no chance of defaulting or very, very low. But the problem was they bought them when they were like yielding 1.5% or lower in some cases, and now they're yielding way higher. And when a long duration bond or security increases in interest rate, it means that if you were to sell it into the market, if you were to sell one of the old ones on the market, it would trade for the same interest rate as the newly issued ones do, which means it has to be sold at a discount so that the effective interest rate until it matures is the same as that new interest rate. So basically the price goes down as interest rates go up. And so what you have a lot of these banks have is that they're holding safe assets that are basically guaranteed to pay back, but they're temporarily underwater. And they're able to hold those until maturity and get all their money back, unless there's a bank run that makes them sell at an inopportune time. And so that's what we saw with Silicon Valley Bank. You basically had they were on the far end of the bell curve of both sides of that risk. So one, they were all in like these long duration assets, whereas most banks are a little bit more diversified with the type of lending they do and the type of securities they own. They instead were, for whatever reason, they were all in on those longer duration treasuries and mortgages. And then number two, the vast majority of their deposits were uninsured because they mostly catered to businesses. And so uninsured depositors are more likely to run in the event of a problem than insured depositors. And so the combination of a more flighty deposit base and having bigger unrealized losses on their balance sheet relative to their capital than other banks put them on like the far end of the bell curve for banks that were vulnerable here. Yes, I mean, well, if they're allowed to. I mean, for example, I think we talked about last time that, the Narrow Bank or Caitlin's Bank, they want to hold all demand deposits at the Fed, and those types of banks have not been allowed to exist. If a bank had held shorter duration assets like T-bills, maybe 2 to 5 year treasuries, things like that, they would have less exposure, and that's why J.P. Morgan, for example, they've been a lot more careful with their duration. They've been focusing on more short duration assets, and so they have less of a problem. But yeah, basically, the more that a bank has done long duration types of assets, the more vulnerable they are to this type of situation. So you don't really see an issue among a lot of the major banks, and instead it's in small banks and in some of these kind of medium and like more niche banks. Well, I think it depends on the percentages. If a bank suddenly started selling its loans and security books, I think it would raise a lot of red flags and questions about what they're doing. But banks in aggregate can't do that. So an individual bank can, but the Fed controls how much total reserves are in the system. And so basically, if a bank is selling its securities and loans and it's holding that in cash, it means those securities and loans are likely winding up on another bank's balance sheet anyway. And so the ratio of total securities and loans in the banking, the whole banking system would still be much, much higher than the amount of reserves in the system. But I mean, even the current ratio is way better than it was in 2008. I mean, back in 2008, for example, there was $23 of deposits for every $1 in cash reserves. So they were highly, highly levered, very, very little actual liquid reserves. Whereas currently it's below 6. So it's not historically high. I mean, I still think, I still think in a fractional banking world, 6 is high. But historically speaking, it's not an unusual ratio at all. If anything, it's on the lower side of my lifetime. But it's a faster world, and it's a world where they have more unrealized losses on otherwise safe assets than they've ever had in modern history, because the Fed's never gone from 0 interest rates to 5% interest rates in such a short period of time so quickly. I believe that was the headline number. Yeah, and to Caitlin's point, they had things like software APIs, so you could pull your money out without even going to the bank website, let alone going to the bank in person. A lot of these regulations are built on grandma going to the bank and pulling out her nickels, but it's not. It's all software APIs, and as Caitlin has pointed out, it's going to get faster with FedNow later this year. And it's funny because right now as we speak, there's a very large brokerage in the United States called Charles Schwab, and they're technically insolvent. Their assets are lower than their liabilities. Because they did the same thing as Silicon Valley Bank did. They bought a lot of long duration safe assets. They're now very much underwater, and the losses exceed their capital. But if you look at Charles Schwab stock, it's down, but it's not cratered. It's still trading at an above average price to earnings ratio, and no one seems to be concerned. And it's in large part because they don't have the other risk that Silicon Valley Bank did. They, less than 20% of their depositors are uninsured, so they're much lower flight risk. And it's a more diversified deposit base, nationwide, and it's kind of in almost like the too big to fail category. But it shows that to the extent of this problem, you have some, JP Morgan's basically unaffected by this. If anything, I mean, everybody, they're benefiting from this. Some banks, like say Bank of America or Citi, they have some losses on their balance sheet, but they don't exceed capital, and they're not at any sort of deposit flight risk, quite the contrary. And then you have a couple other banks like in the top 10 that sometimes they have unrealized losses, but again, they're not exceeding capital, and they're not at risk of deposit flight, or very low risk of deposit flight. And so mostly this is affecting very certain types of banks, but unfortunately that includes a long tail of smaller and less liquid banks.